Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I'm the founder of Advisor Perspectives and a vice chairman of Vetify. The SouthernSun Small Cap Fund, which has a symbol of SSSIX, is up 13.5% this year versus 10.33% for its Morningstar Small Blend peer group. And last year was even more impressive. It was down only 1.37% versus that peer group, which was down 16.24%. And that put SSSIX in the first percentile of its peer group. It has approximately 400 million in assets. It's a highly concentrated portfolio. It had only 21 holdings as of the end of March. Michael Cross is my guest. He is a portfolio manager and a principal with SouthernSun, and he is a manager of SSSIX. Michael joined SouthernSun in 2008, and his responsibilities include the research and analysis of investment opportunities and monitoring of existing portfolio companies, and he provides input on portfolio management and construction. So, Mike, I did some research. I see you have a very interesting background. What led you to make the move from working for a major public company like Cummins to a boutique asset manager based in Memphis? Tell me about your career path and your role at SouthernSun.
Sure, Bob. You're right. My resume probably doesn't look like your typical portfolio manager. I spent the first 24 years of my career at Cummins. It's a great company based in Columbus, Indiana. And at Cummins, I had a number of different roles. I ran the parts business for North America, Europe, Middle East, and Africa. And the parts business, as with a lot of industrial companies, is really the cash cow of that business. Then I started up a new business unit for Cummins that was all about making diesels cleaner, getting products in compliance with tightening emissions regulations around the world. So I had operations in the US, in the UK, South Africa, Beijing, Sao Paulo. We did research in India. So basically, I was never home. But I gained a ton of experience there in general management, operations, distribution, aftermarket, new product development, Six Sigma, and supply chain. But throughout that career, I was really a bit of an anomaly because I spent all 24 years in Memphis. They wanted to move me to Columbus, Indiana, and several other places. But my wife is from Memphis, and she wanted to stay there. So my goal was to keep her happy. And for a long time, they just kept making good opportunities available for me in Memphis and allowed me to stay. But eventually they wanted me to move, and we didn't want to. So in 2008, I left Cummins and began talking with a really good friend of mine named Michael Cook. And Michael is SouthernSun's founder. Michael, he thought it'd be good to have somebody on the investment team that had an industry background, that knew what they were looking at when they went into a manufacturing or a distribution facility, that understood quality systems and improvement strategies like Six Sigma, and that had worked on supply chains and product introduction. So way back when, my MBA is in finance and accounting, and I passed the CPA exam. So I was already comfortable navigating financial statements. But joining SouthernSun has been terrific, kind of a second career for me. And as you said, my role is to help us search for new ideas. I'm responsible for research and interaction with a number of our portfolio companies. And I create models and work on valuation and contribute to the discussion around portfolio construction.
Well, we have one thing very important in common, but one thing that we don't have in common. What we share is that my wife is also from Memphis. In fact, she is a third generation Memphian. I was married in Memphis and have, of course, been there many, many times. What we don't have in common, though, is that my wife was willing to move to Boston, where I live now.
Well, we'll have to follow up on that discussion.
Okay. So tell me a little bit about SouthernSun, about its sort of positioning as an asset management company, and then tell me about the mandate of SSSIX.
Well, SouthernSun is a boutique. We're long only small and mid cap manager and equity shop just in Memphis. We're 100% employee owned. We were founded by Michael Cook back in 1989. So we've been at this a long time. 34 years. Michael is still engaged. He's our CEO and he's our co-chief investment officer. And way back when, he started with small cap because he believed, and we still believe, that you can find less understood, high quality companies that are trading at attractive valuations in this market cap range. And that gives advisors and their clients the opportunity to earn some nice returns over the long term. So our mandate is to build and manage a portfolio of investments in small cap companies using our philosophy and process that will give our clients nice long-term returns. And when I say nice, our goal is 10 to 12% above inflation or mid-teens. That's what we're shooting for.
So let's talk about your philosophy and process. Tell me about the strategy that you use, how you identify companies that you hope will outperform, and also how long do you typically hold a stock, and what is the criteria you have for selling it?
We're a bottom-up, research-intensive shop with a value approach. We do our own research. We don't rely on the sell side. And what we're looking for are high quality companies, and we do it through kind of a boots on the ground approach. We attend trade shows more often than we attend sell side conferences. We go visit portfolio companies' facilities. We talk with management teams about their suppliers and the industries in which they operate. And that often leads us to some interesting names. And we have some clients and advisors that tell us we own some names that they don't see in other portfolios, some unique names that are interesting. And I think that's probably a function of our really independent approach. So we look for companies that have a strong market position. So they're typically the market share leader in the niche that they sell into. We call that niche dominance. And it's really kind of fun in the small cap space because you really find some really interesting niche companies. We also look for companies that have financial flexibility. So what does that mean? It means we want to see a strong track record of generating cash, not growthy companies that one day might generate cash if all the stars line up. But financial flexibility is also about solid balance sheets. So you'll see much lower leverage across our portfolio than that of the overall index. And finally, financial flexibility can also have to do with the company's cost structure. So how will the company behave when revenue drops, and can they shed costs quickly? So that niche dominance and financial flexibility are important, but we also care a lot about who is running the company. So we want to clearly understand how that team is going to create value for shareholders over the next 5 to 7 years, and are they really rightly fitted for the task in front of them? You asked how long we'll hold stocks. Well, maybe we're a little different here because we hold shares for a long time. As long as we believe that that company can help us achieve that mid-teen returns target for our advisors and their clients. Several names have been in our portfolio for more than 10 years, as an example. So you asked why we'd sell. There's several reasons. First, it's about returns. So if the stock has run and we feel it is fully valued and that it will not be a contributor to that returns target, then we'll sell it and we'll replace it with something that we think offers a higher return. We'll also sell if something material changes at the company or in the industry and that undermines our thesis. So let's say we bought a company with a really clean balance sheet and then they decide to take on a bunch of debt and do a transformative acquisition. Well, we're likely to sell or go to the sidelines and come back and try to re-underwrite that name to see if it still has a place in our portfolio.
You're looking for financial flexibility, niche dominance, but I'm interested in your performance last year. As I mentioned in my introduction, your fund ranked in the first percentile of its peer group. How did you accomplish that?
In a nutshell, if you look at it, it was driven by stock selection. So by and large, our companies performed well in an uncertain and kind of tough environment. In our opinion, last year was a year in which fundamentals, meaning balance sheets and execution and in-market dynamics, that actually mattered to investors last year. And that's the kind of environment that is good for our strategy.
So you talked earlier about your research and the fact that you rely on boots on the ground and going to trade shows? Is there anything else that you can tell me about what differentiates your research process from your peers?
We really don't listen a lot to the sell side, and we really try to come up with our ideas on our own. We travel a lot, and we always have. Um, we like to meet with these management teams face to face and on their own turf, and we want to hear them tell us how they're going to grow value for shareholders, and we want to hear kind of a fire in their belly that they're going to go get it done, and we want to understand whether they have the skills and experience and are rightly fitted for their strategy. So if their strategy is about improving operations and reducing costs, we want somebody who's done that before and has capability and a track record of doing it. We also like to meet with people that aren't just in the C-suite. We want to make sure that what's actually happening at the company is what they say in their PowerPoint presentations. And in order to do that, we like to talk to plant managers and engineers and marketing people and supply chain people, just to make sure that the messages that we're hearing around strategy and culture and value creation have really been deployed through the organization. And it's not just somebody who's really good at presentations giving the pitch.
You mentioned earlier that you hold companies sometimes for as long as 10 years. I'm interested. Can you give me an example of one of your holdings that best illustrates the investment thesis, methodology, and the diligence that you go through in researching companies?
Actually, kind of a recent addition to the small cap portfolio, and that's Boot Barn Holdings. The ticker is Boot, BOOT. And as you might guess, they're a retailer of footwear, of clothing and accessories, and mostly with kind of a Western style. But they're really about the clothing and footwear that people need for work. Okay, this is about outdoor work, ranching, farming, construction, but also distribution jobs and manufacturing jobs that require steel-toed boots and such. They throw a little bit of fashion in there, but fashion is really not the driver of this business, nor is it a big risk if it doesn't really perform really well. Their largest direct competitor is only about a fourth of their size. So they're much bigger than their competitors. And that's kind of what we mean by niche dominance. That's one aspect of it. Today, they have about 360 stores in 46 states. But what's exciting about this is they've got a plan to get to 900 stores over the next 8 to 10 years. And they can do all of that expansion with internally generated cash flows, keeping their balance sheet pretty darn clean. And that's one of the things we mean by financial flexibility. They can grow with the cash that they generate. New stores only take about a $1.4 million investment, and they pay back in less than 2 years. So Boot can keep driving their financial performance forward through new store growth, but they've also got levers for margin improvement along the way. We've spent hours with their management team. In fact, last December, we met the whole team in Las Vegas to attend the National Rodeo Finals. Boot Barn was a sponsor, and we had a great time just getting to know them and attending the rodeo in a more informal setting.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects. My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. You're a concentrated investor. I think as of the end of March, I mentioned you had 21 holdings. What are the advantages of that approach? And what do you say to advisors who think that such a focused portfolio is risky? What is the risk management discipline that you use for the fund?
So let's be really clear on concentration. Like you said, we own 20 to 25 holdings. Typically, it's not 5 or 6 holdings. That would be really, really interesting, but way concentrated. So we believe owning 20 to 25 stocks gives us plenty of diversification. And from a risk standpoint, we keep track of not just the sectors and industries that GICS takes, classifies companies in, but we look at where are their end markets and what are the drivers of this business. So we track that over the last 17 years. Since 2006, we can tell you where our exposures have been by end market. And we just are careful not to let those get outsized so that we could have a risk of one market really doing poorly and affecting the whole portfolio. But when one of our companies does well, when you run a concentrated portfolio, one company or 2 or 3 can actually move the needle in terms of performance. So when advisors are seeking alpha, we think it makes sense to invest in a more concentrated portfolio as long as the manager knows what they're doing. So our view of the biggest risk, or one of the biggest investment risks, is not knowing your companies well. And it's a whole lot easier to do that when we own 20 companies. It'd be a lot harder to do that if we ran a portfolio of 80 to 100 companies, and we probably wouldn't do it well.
What is the expense ratio for the fund, and what's been its history of capital gains distributions?
So all this is available on our website, southernsunam.com. The expense ratio for the investor share class is 1.06. You can see the full history of capital gains distributions on that website. And when you see that, you'll see the majority of our gains that we distribute are long-term gains, which is understandable given the long-term investment approach and the fact that we hold companies for a long, long time.
And we'll have a link to that website in the notes that accompany this podcast. Why did you choose a mutual fund structure instead of what's become fairly popular now, which is an actively managed ETF?
One thing is that the fund has been around for quite a while. It's been around since 2003, and I don't think actively managed ETFs were even available back then. But secondly, through the years, most of our clients are institutional in nature. They're corporate clients or family offices or larger clients, and they just haven't been asking for that active ETF vehicle. So it's out there. If we had sufficient demand from clients, we'd certainly consider taking a look at it. But at this point, we've got the 40 Act funds.
U.S. equities are valued at a historically rich level. The Schiller PE is about 31.75. That's nearly twice its average over the last 100 to 125 years. Technology stocks have driven that performance. They've done exceptionally well recently. What do you say to those who are worried about overall valuations and are worried specifically that a collapse of some of those big technology stocks would spill over into small caps?
I would say there's probably a reason to be worried about overall valuations. But I'd also say that this is a time that you want to be very selective about what you own, what companies you own, um, and what managers you're working with. So I think it'd be tough to put together 100 stock portfolio and find enough companies with a really attractive valuation and have confidence that you could earn good returns for your clients. But that's not what we do. Okay, we're pretty confident, and with the 20 to 25 really good businesses that we've put together in our portfolio, and we think there's always an opportunity to find a few hidden gems out there that can give clients the kind of returns that we're looking for. And if there is a collapse of big tech stocks, I'm sure there could be a contagion that pulls everything down for a while. But in the end, it actually might make our strategy and what we own even more attractive, because we're owning businesses that have strong fundamentals, that are in solid industries, that got good balance sheets and solid prospects for growing shareholder value.
Is there anything that I didn't ask you about that you wish I did? Any questions that we didn't cover?
Maybe one that I think it really, in the small cap space, I think active management really makes sense. Obviously, we do. That's what we do. But when you think about the Russell 2000, which is what most people equate to the small cap universe, some folks don't realize that about 40% of those companies have negative income, and almost 30% even have negative EBITDA. So small caps can be a great investment, but we think it's really important to pick your spots and put together a portfolio of high quality companies. One other reminder is just that at Southern Sun, US small cap and US mid is all that we do. We don't have other products. We don't contemplate adding other products. Our goals are to achieve these mid-teen returns, and we're capacity constrained, and we'll close the strategies at some point when it's appropriate to do so.
If there's one key takeaway that you'd like to leave with our audience of advisors about the diligence that they should perform on a concentrated small cap fund like SSSIX, what would that be?
I think one really important thing is to understand how long the team that is managing the money been together. At first, maybe it's because I came from industry and I was new to this whole thing. I didn't appreciate how important it was, but after 15 years, I think it's really huge. When you think about our team, we've been through cycles together. We've been through the global financial crisis, through commodity cycles, an industrial recession, a trade war, a pandemic. We've made mistakes together, and we've learned from our mistakes, and we've made our processes and risk management better over time. So our firm right now, in my opinion, is the best it's ever been, and we're really excited about the future. And I think that that strength has a lot to do with the experience we've had working together.
We're going to include some links in the notes that accompany this podcast. There'll be a link to the Southern Sun website and a link to the SSSIX fact sheet. You'll be able to see information about the expense ratio and capital gains distribution that Mike mentioned earlier. Mike, is there anything else you'd like to add?
No, I think that's it. Thank you very much for this opportunity.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Michael Cross of Southern Sun. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.